Welcome to The Explainer. Today, we're diving into the absolutely massive world of Forex and gold trading. This is a market that moves trillions of dollars every single day, but what actually makes it tick? Well, let's break down the forces that really drive these global markets.
So let's start with the big question, right? What is it that actually moves the price of something like gold? And how in the world is it connected to all the currencies we use every day? By the end of this, you're going to see that link crystal clear.
First up, let's talk about Forex. You've heard the term. It just stands for foreign exchange. Now, this isn't some building on Wall Street. It's a huge, decentralized global network where currencies are traded. And when I say huge, I mean it. We're talking trillions of dollars changing hands every single day. It is by far the biggest and most liquid financial market on the entire planet.
And here's the crazy part. This market pretty much never sleeps. It literally follows the sun around the globe. It kicks off in Sydney, moves through Tokyo, then London, and wraps up in New York. It's a non-stop, 24-hour-a-day, 5-day-a-week operation.
Okay, so to really get how this all works, we first have to speak the language, So let's quickly decode some of the essential jargon you're going to hear all the time.
First thing you need to know, everything in Forex is traded in pairs. Take the most common one, the Euro-USD. The price you see is simply telling you how many of the second currency, the quote currency, in this case dollars, it takes to buy 1 unit of the first, the base currency, which is the euro.
And how do we measure those tiny price changes? We use something called a pip. It's usually that fourth decimal place. Just think of it like a single cent on a dollar, but for currency pairs. It's the smallest unit of measurement for any movement.
Now, you'll always see two prices listed, a bid price and an ask price. That tiny little difference between them, that's called the spread. And that's basically how your broker makes their money for handling the trade for you.
All right, now for a really powerful and really important concept, leverage. In a nutshell, this is borrowed buying power from your broker. It lets you control a much larger position in the market with a relatively small amount of your own capital.
But, and this is probably the most crucial thing to understand about leverage, it is a massive double-edged sword. Yes, it can absolutely magnify your profits, but it will magnify your losses just as fast and just as much. You have to respect it.
Okay, so we're starting to speak the language. But what's the engine behind all this? What actually makes these prices jump up and down all day?
Well, these price moves are not random at all. They're driven by some really powerful economic forces. Think about it. When a central bank like the U.S. Federal Reserve announces they're hiking interest rates, that can make the dollar a lot more attractive to global investors, which can cause its value to go up. The same thing happens with big economic reports on things like inflation or jobs. Every single piece of data shifts the landscape and causes these prices to constantly fluctuate.
So we've covered some of the theory. Now let's make this really concrete and look at an asset everyone knows, gold. In the trading world, you'll see it represented by its symbol, XAUSD.
Now that symbol might look a little technical, but it's actually super simple. XAU is just the international code for 1 troy ounce of gold, and USD is, you guessed it, the US dollar. So when you look at the price of XAU-USD, you're just looking at the price of 1 ounce of gold quoted in US dollars. That's it.
And just like currencies, gold's price has its own key drivers. It's super sensitive to things like US interest rates and the overall strength of the dollar. But here's the big one. Gold is often known as a safe haven asset. What that means is, during times of global fear or uncertainty, what traders call high risk sentiment, investors often flock to gold for stability, and that demand can push its price way up.
So how does this translate into actual money? Let's say you have a position of 10 ounces of gold. If the price moves up by just $15 per ounce, your position's value increases by $150. It's that direct, simple math that traders are watching, literally moment by moment.
We've talked about how it works, and we've talked about the potential. But we absolutely 100% have to talk about the other side of that coin. And that, of course, is risk.
Let's circle right back to leverage for a second, because this is where risk becomes so incredibly real. That amazing power it gives you to amplify your gains comes with an equal and opposite power to amplify your losses. That is a non-negotiable part of the deal. Using leverage is like playing with fire. It demands extreme caution and a whole lot of respect.
And this brings us to what is, without a doubt, the single most important rule in trading. If you take nothing else away from this, please remember this. Never, ever risk money you cannot afford to lose. Full stop.
So how do the pros handle this ever-present risk? Well, it's all about a disciplined process. It starts by deciding exactly where you'll get out if you're wrong. That's your stop loss, before you even enter the trade. Then you choose a position size that ensures if you do lose, it's a loss you can easily handle. And finally, and this is the hardest part, you have to have the discipline to stick to your plan no matter what, taking your emotions completely out of the equation.
And all of that leaves us with one final question to think about. Now that you know the basics, you know the powerful forces at play, what do you think the biggest risk really is? Is it the wild, unpredictable market itself? Or is it the unprepared, undisciplined trader?